Now, the Reserve Bank is set to meet next week with yet another rate hike, all but certain. The question of how much. It does also beg the question of, can Australia curb inflation and avoid a recession? That's what every economy is asking at the moment, as to where they're likely to go and how central banks are responding to the inflation surge. Well, Shawn Hickman is joining us from Market Matters to discuss that and some investment opportunities. Shawn, good to see you. Let's first take a look at where we've been. Now, particularly overnight, we saw that we're back to those June lows, aren't we?
Without doubt. The market's been all over the place, but with a definite downside bias.
All right. Where to from here? Put your crystal ball, polish that off. Let's first look at the US market. Are you seeing opportunity there now?
Definitely. We're bullish from here. I'm not sure if that puts us in a contrarian camp, but certainly a bold camp. We think the markets will rally into Christmas. You've got about, give or take, $5 trillion US dollars sitting in cash on the sidelines. People are very, very scared. And at some point in time, like we saw between June and August, we think that will come back in the market and the market will rally. Maybe on light volume, maybe not a convincing way all the way through next year, but we think a lot of value is being presented and that money will come back in the market and there'll be a lack of selling, because where's the selling going to come from now?
Well, although could that be derailed, particularly if the US does fall into recession? You could argue perhaps it's already there. More importantly, I guess, if we start to see job losses.
Yes, without doubt. I think we are going to go into a recession. The question mark is how deep. There's plenty going on, but the market's already corrected more than the average correction during a recession or into a recession. So there's a fair bit of bad news factored in. Obviously, the market is probably going to pull back even further, in my opinion, because it came off of very high inflated areas because of how much money was pushed in the economy and pushed into equities. But I think we're just going to see a market with lots of cycles, lots of ups and downs, sure, with a downside bias. But we believe the next move is on the upside, not the downside. What
are the Treasury yields telling you at the moment? I mean, yet again overnight they leapt, particularly the 10-year.
I think they're telling the overall story. I mean, the 10 years are trading near 4%. You've got less than a 2% yield from the S&P 500. So by definition, if you can put your money, bang, get 4%, or put it into equity at 2% and be scared, you've got to feel very confident that stocks are going to go up, and the majority of people aren't. So that's what creates the opportunity. But at the moment, it's a big headwind that isn't going to go away in a hurry, and that's why we don't think equities are going to go much higher than the August highs.
So are you perhaps beginning to rotate from value into growth?
Big time, big time. We've been talking about that the last few times I've been on here with you, and we think it is time to move into those growth areas. We saw it big time yesterday, to repeat myself. We saw a big unwind of energy and resource stocks. We think that's going to be ongoing over the next month or two. But again, it might be a week or two because it could be such a dramatic move, because it's a very, very crowded trade. People are long energy, they're long resources, they're underweight tech, and we just think we're going to get a bit of a snapback in that elastic band.
All right, just before we talk stocks specifically then, so beyond tech, any other sectors you're looking at?
Anything that's, I think, I'm going to go out on a limb here and say that we think bond yields are close to the top. They're being pushed there obviously by the UK, and some very fascinating moves out of there, which are very hard to fully understand. But I think what's going to happen if we get a bit of a plateau or pullback in yields, the interest rate sensitive areas, so maybe to a lesser extent property and stocks like that. Consumer discretionary, you've got to be very selective, but some of those stocks I think are getting oversold.
All right, well, let's focus on some of the stocks you're looking at locally at least. Begin with SEK.
Yep.
Once again, I mean, this could come down to what's going on with the jobs market, couldn't it?
I willed it as well.
Yeah.
But by definition, the SEK has come down a long way already. We've talked about it, or I've talked about it the last couple of times I've been on here to see you. We bought it when it first floundered these sorts of areas, and we said to you last time, or I said to you, I should say, if it makes a new low for the year, we'll be stepping up and looking to buy again. And over the next 24 hours, I think there's a very good chance that Market Matters will be back in the market buying SEK again at these levels.
But once again, it comes back to that question I put to you as far as the States. If we start to see those job losses, have less people advertising for jobs, clearly.
Yes.
How does that affect SEK?
Well, it's not good, but you've got to look at where SEK's gone. Don't forget, you know as well as I do, that markets look at 6 to 12 minutes in advance. They're already pricing in, stocks like SEK are already pricing in a recession, they're already pricing in a contraction in the jobs market. When everyone's on the same horse, that is when you want to start picking up some value in stocks that have been hit too hard. So we're looking for SEK to rally back to that $20, $22 area. Normally I'd call that almost trading, and I'm trying to avoid that conversation when I talk to our clients at Market Matters. But we're in a market that's an active market, and 20 to 25% swings shouldn't be ignored.
All right, another one you're looking at in the property sector is Goodman Group. It's share price come off about 25% over the past 12 months.
Quite a common theme throughout the whole sector, whether it be property or whether it be tech.
Yep.
The same thing. We think this is a quality operator. It's got branded with both property, it's got branded with tech, as we know. It's been sold off a long, long way. We lightened our holding into the strength in August. We're considering increasing it back up into this pullback. In other words, adding some tweaking, adding some value, adding some alpha around the edges of a portfolio in core holdings.
All right, and finally, James Hardie. Now, interesting in terms of building products, not just here, but clearly with big exposure in the States as well.
Yep, absolutely. But again, yesterday, James Hardie was up. Obviously, one day doesn't change the whole picture we're seeing. We saw that with SEK yesterday. We saw that with REA. A lot of these stocks are getting to the point where people are saying, okay, as I mentioned before, we've got a lot of cash on the sidelines. What looks good value here? They obviously decided yesterday that Whitehaven Coal or BHP didn't, because they're already very, very long those stocks. Whereas the resources have run hard. They've sold off aggressively into the tech, and so they're starting to pick up some bargains on the back foot.
Once again, okay, so the share price for James Hardie looks compelling. However, if we do fall into recession, that again is going to hurt the company.
Without doubt, but again, it comes back down to risk reward. At what point in time does the risk reward warrant getting exposed to some of these stocks? How far have they fallen? What are they building into? What comes next? And we feel that what comes next is arguably not as bad as what's being built into over the next 3 to 6 months. Does that make sense? The market looks ahead. So next year, this time next year, do I think some of these stocks will be lower? Of course I do. Because we're having to understand that we are getting a contraction in cycles. How deep will the recession be? It was only in August, no one was talking about recession. Everyone was scared about interest rates. Everyone was scared about bond yields. Now we've got a complete opposite. The bond yields, they've gone up, that's fine. Recession is a scary one. And we saw that obviously last week. Jerome Powell said it's going to be very, very hard to avoid a recession.
So, Shawn, if you're looking to buy, then presumably you have a fair bit of cash on the sidelines at the moment.
Exactly. We've been cashed up since August, as I said before. We took some off the table in August, and we've just started putting some of that money to work. So we like what's happening now. Most people don't, we do.